All right, hello everybody, and welcome to our monthly discussion group. A lot of activity, call it January and February that we want to go through. Obviously, there's been some uncertainty with what's been going on with the Fed. We look at inflation, rising interest rates, and also tapering their purchase program. And you also have some of the recent news about what's going on overseas that I want to touch on how that's going to impact, potentially impact markets and sort of what our plans are for, these types of situations. And Jared, you kind of go into some of those concerns and what we're looking at right now?
Yeah, if you looked at coming into the year, some of the biggest concerns we had were what you just said, Michael: overseas conflict, China, Taiwan, or Russia, Ukraine, and the Fed tightening. Here we are toward the end of February, and we're in the middle of both, right, at this point. And it's never fun to be in the middle of the downturn. I mean, the S&P, as we're recording, is down about 10% so far this year, around both the concerns overall. And it's real from the standpoint of concerns. I mean, it's scary times when you look at inflation we haven't seen in 40 years. And anytime there's conflict overseas, it does open up, challenges as we're all kind of watching the news day to day and everything else. So as we look to where to go from here and what's ahead, the Fed is going to come out in roughly a month from now and raise interest rates for the first time in many years. So we're kind of putting all of this negativity and uncertainty all at once as the market's trying to figure out where to go from here. So with that, as you look at maybe the Fed policy, Megan, I'm going to start going over what's expected here.
Yeah, so I'd like to pull up the dot plot for the Fed. And we took a snapshot of the predictions for September and then again in December. So if you see in September for this year, it was predicting maybe one rate hike so far at 25 bips. If you see it again, if we flip ahead to December, it's now kind of factoring in 3. So if you've been following a lot of the news outlets, there's a big debate right now between if they are going to do 2 rate hikes this March or 1. So if we kind of read through as to what we think, sorry if you can hear my cat in the background. So if we kind of read through why we think they might not do 2, there's several factors that play into that. For one, there's obviously what Jared just touched on, which is kind of the unrest overseas. That could pare that down a little bit to make them have a more gradual approach, as well as the supply chain issues. We did have a graph that we didn't put in, but there was a chart with the turnover time for the port in Los Angeles. And you can see a lot of those issues are starting to be worked out. There's a lot of other headlines showing that a lot of those kind of bottlenecks per se are starting to work through the system. So that should naturally taper off a bit, which would ease the concerns as well. And then from a political standpoint, just kind of the lower market volatility going into midterms is always kind of a plus. So there's several reasons why they might not double hike this March, but the predictions were there. And if you looked a couple weeks ago, there was about an 80% prediction that it would be a double rate hike. And then through today, it's now about 40. So we still have about a month until that actually plays out. A lot can change between now and then, but there's a lot of items that we're looking towards right now that show it most likely will probably be 1 rate hike at this point.
And as you said, Megan, I mean, the Fed's going to be very data dependent, right? There's a lot of uncertainty near term, and we still have all the inflation concerns. That is a big reason for trying to hike interest rates twice. So speak of that, Michael, let's talk about some inflation.
For sure. Let me pull up this one chart here. So one thing that we're seeing right now with inflation, at least over the last 12 months, is the actual level of inflation from the month over month perspective has been higher than what the survey amount has been. So that's represented the actual by the blue line and the survey by the gold line. And the way the year over year inflation number works is it's not necessarily the last sort of rolling 12 months of the month numbers of inflation. It's more of a product of them. But what you'll see is that when you start getting to your Marches, Aprils, Mays, and Junes, that these higher sort of individual month over month numbers should fall off. And if we are looking to taper, or inflation starting to even out, those larger numbers should be falling out of the calculation with smaller numbers being added. So just from that sort of pure mechanic standpoint, you should see the year-over-year inflation numbers start to drop. But another way that you can look at that is really with the, if you look at the stock market or you look at the Dow Jones, where, a 300-point move today, isn't really moving the needle for that index. Whereas you go back 10 years, 15 years, 20 years, a 300-point move was a significant percentage change. Mm-hmm. So with inflation, because we're at this higher base right now, future increases, it's going to be harder for it to really move the needle from a more significant standpoint. So again, from our perspective is that obviously that's a good thing that if inflation starts tapering and you get a little bit more price control, but you also have to ask, are we sort of at peak inflation now? Stock prices right now have peaked in January, and they tend to be a bit of a leading indicator, but you look at housing prices, which are up, call it 18, 19% last year. You look at gas prices, sort of energy prices overall that have been up. And it's just sort of a, if it's not peak now, then when? And one other interesting thing we saw was the prices of used cars. So we've got just an interesting chart to look at from there too. So historically speaking, your used cars, you continue to drive them, they, you have to continue to maintain them. So there's always this expense going into them. So if you go back, this is going back about 10 years, where you see the changes in prices of used cars is for the most part been negative throughout this whole period of time. A little positive activity in 2018, 2019, but then you saw kind of April last year when prices really spiked, and you saw that this January you had about a 40% year-over-year increase in the value of used cars. But historically, it's been a negative returning investment for you. So from our standpoint, you aren't going to see a continued 40% increase in the value of your used cars. So those are the types of things that we expect to come down, which will also bring inflation lower with them.
Well, when you think about what you're saying, Michael, the Fed got criticized last year for calling inflation transitory. Mm-hmm. When you look at the first part of that graph that you had in the CPI, what they were thinking was that the January, February, March, April numbers were going to be the peak last year. They turned out to be very wrong. But I think our view is they were just a year early, right? It feels like a lot of what we're seeing now is the transitory stuff the Fed was talking about a year ago. It's more likely to play out this year than it was last year at this time. And that's a reason to be cautiously optimistic ahead on inflation concerns as well, because to your point, April seems to be the month where a lot of these changes are going to fall off. Megan and I know it well from Florida real estate perspective last year when you saw a major surge, right? But as it starts to level off, that's a reason to be optimistic that maybe inflation is finally transitory as we get things through. So let's talk about some of that. Megan, what are your thoughts on maybe oil and energy? Are we at the peak right now, or is there a little more to go?
So, I mean, I think you could argue this either way, but with the overseas unrest, that's obviously driving up a lot of the oil prices currently and commodities in general. But with oil where it's at right now, let's say a lot of this is resolved in a couple months or less, the oil prices will naturally pare back down with a lot of that, the pipeline issues and a lot of the kind of geopolitical issues put aside. So a lot of it could be baked in already, showing that it's at peaks. And to Michael's point with the used cars, just historically, used cars never appreciate. So that trend can't continue. A lot of it was back to the supply chain issues and other things breaking down with the chip manufacturers and everything like that. So as that works through, a lot of those trends will pair off. So what's kind of pulling up inflation in general in some of those different categories are naturally going to resolve themselves and then should hopefully bring the overall figure down back to kind of more of its parity.
And when you look at another topic is wage inflation, right? I mean, we saw gas prices, housing prices, energy prices in general up over 20%. Wages have been very reluctant to keep pace until recently. So wages seem to really have caught up in the last few months and have a few more data points ahead. So Michael, are we at peak wage inflation or is there higher wages ahead?
I think there's probably some more room for higher wage inflation. You look at the latest labor participation rate number that came out. It was up a fraction of a percent, but that still was about a little over 1 million people that rejoined the workforce, and that was because of those higher wages. And as companies are still looking to find workers, it doesn't really matter what industry they're in. There is a bit of a shortage. So I do think that that's really the only way that they can incentivize people to come back to the workforce is by increasing the wages and just what they're offering, whether it's the wages or signing bonuses, just the overall compensation packages are going to have to increase for people. And I think that, as I've been saying, there is still some more room to run, but it probably will continue to, probably will peak at some point soon as well.
When you bring some of this back to where we're starting part of the conversation is the Fed and raising interest rates. The Fed will, my best guess is 3 rate hikes is going to be pretty close to the number we get this year. You've seen 6, 7, 8 as predictions. And again, the Fed's going to be very data dependent. If they're wrong on inflation like they were last year at this time, we will get more than 3 rate hikes. But if some of these positives come to fruition, you'll be closer to 3 or 4 rate hikes overall, because the Fed will get to more of a neutral policy and not have to get right into tightening overall. And again, I think the key surprise there that you just went over, Michael, is labor participation, because wages have been so low relative to inflation. Now, if COVID is really turned into more of a rear view mirror issue from a labor force and kind of overall getting back to normal, that's something that should bring people back. Higher wages, safer working conditions, and balance, right? I think companies have adjusted a lot from working from anywhere or a balance between the office and such as well, which makes it more attractive for workers to return to the labor market overall. And that should help with wage inflation ahead. I agree. I think we're to see higher wages near term, but if the labor participation continues to increase, that should help the Fed not have to raise as much as well.
For sure. And I think, as we talk about inflation and we talk about rising wages and things, eventually starting to taper and settle, that we start looking at it from a company perspective. What does that really mean for, different corporations? What does it mean for their stock prices? And if we look back at fourth quarter earnings that have been coming out, most companies have had great earnings. They did really, really well. However, they have been they've been cautioning us about their forecast for the rest of this year, that they do see a bit of a slowdown, and that could also help inflation if there isn't as much spend, there isn't as much churn, that could bring down the rate of inflation. And when we're looking at so far this year, what's performed well, what hasn't performed well, you've seen a lot of volatility within a lot of the high growth companies, a lot of big tech companies, just companies that have these very large valuations. And as we're in this rising interest rate environment, those types of names don't have as much of a buffer to sort of support themselves from the falling share price. So what we have seen do well are companies that have low PE ratios, pay high dividends, and generally speaking are the more value-oriented companies. In areas that these companies generally are more sort of energy companies. You're also seeing financials, and those are just sort of 2 sectors within the S&P that are still positive on the year. You see pretty much everything else has been negative. So from a opportunity standpoint, we see more of our funds shifting towards those value names that are paying the high dividends that we think will continue to do well during these periods of volatility.
And when you look at the high valuation, to your point, Michael, some of the challenges, you think about it from an investor, if a company was growing at 40% per year, and now they're only going to grow at 30% a year or 25% a year, it doesn't sound like that big a difference. But when you have the high growth, you were pricing in 40%, and now it's only 20, 25, 30%. It's a big valuation down. And then when you think about part of the reason why, I mean, you used to have the dividend discount model from, a long time ago of valuing companies, or just a cash flow assessment. As interest rates go up and you discount those future cash flows back to today, if you're not paying anything back, if you're not doing share buybacks or raising dividends, that really hurts your valuation as it adjusts. And that's exactly what you've seen on a lot of that. Whereas the dividends and value-oriented companies, they've been doing a lot of share buybacks, dividends, and increasing dividends, and that gets cash sooner to shareholders, which is more valuable in this environment overall. So it's something to continue to watch for.
Agreed. And I think that's why we've seen this past year alone, so many people pivot into real estate. And we actually have a chart of just kind of the real estate growth and then the S&P growth over a similar period. And it was hard during this volatility to not want to put all of your funds into harder assets like real estate. But if you look over the same period of time, in general, the market, while it's volatile, different industries benefit during different periods of time. So to make sure to keep exposure to that overall area is, almost a 5% spread right there, or 6% spread that you're making from the market as opposed to real estate. The difference right now with real estate, so this past year, Michael kind of touched on it, that 2021 had 18.8% year-over-year growth, which is the highest it's ever had in history. And while that is astonishing, it also, you can kind of read it through that's just a huge market of millennials finally getting into real estate, whereas so many people were renting and putting it off. But with rental prices increasing, that spread between the rent versus own is narrowing, and people are more pressured to buy, paired with wanting to lock in lower interest rates, paired with all of this volatility in the market. So there's two different read-throughs, but from an overall perspective with the stock market, and we kind of touched on it earlier, but when there's unrest elsewhere, that's kind of the best time to buy. So even though there's certain industries that are going to be affected more than others, in general, the market as a whole should still be pretty well priced for this next short-term period.
When you look at that too, Megan, I mean, if you look at it, as you just said, there's maybe a different viewpoint as well, that if you have been in stocks and have done really well the last 8 to 10 years, a lot of the real estate price increase, you could argue too, is people rebalancing, taking some profit on stocks and buying their real estate, either for the first time or a second home or those kinds of things as well. So the question is that a value play, Michael? I mean, are people rebalancing from their growth in the stock market to get into value or hard assets in real estate? Is this going to last a little bit longer?
No, I think so. As you've been saying, that you've seen this rotation more towards these hard assets, and stocks have just done incredibly well. At this point in time, it doesn't not make sense to take some of that money off the table, put it, if you want to put it into real estate as another opportunity, and really look to lock something down for the next several years. And as Megan, you said, with millennials starting to get more involved with buying real estate, that you still have a lot of buyers in a market where you don't have that much inventory. So until you can really get a lot of houses built and just really sort of, fulfill that demand, it's going to be hard to see a scenario where housing prices don't continue to increase over time.
Right, just not at maybe the growth rate that they saw.
Right, correct.
Last year.
Right.
Well, on top of it, I think we've reviewed many financial plans and overall net worths for families. And because of the price appreciation in stock portfolios, you can argue that families are a little bit underweight real estate or underweight hard assets or alternatives as well. So it is sort of a natural rebalance that does make a lot of sense given the uncertainty, and the relative value probably does support this for a while. So now let's look ahead. We've been talking about this since COVID started. Is spending differently, or our behaviors are different? So now as governors kind of do away with mask mandates and other restrictions, last year we thought was going to be the year of experiences, but it looks like it got pushed off a year, kind of like the Fed's transitory comment with the extra variance that we all went through last year as well. But now let's look ahead. How are we going to spend a little differently, and maybe what might be some opportunities with that this year?
Sure. So I definitely think you could probably see a record number of weddings. I know my sister-in-law recently got engaged, so I don't know. I think she's planning for next year, but I know that she's still looking at seeing what's open right now, and if there's an opportunity, probably might take it. We also look at different events, whether it's concerts or graduations or different types of festivals that people are wanting to be outdoors. You could see a lot of people sort of drive those types of that type of activity.
And then when you look at to the experience in travel this year, I mean, travel's continued to pick up. It's slowed down with Omicron, but the airlines through their quarterly earnings all said that we'd see a major pickup in travel starting this past weekend with President's Day. And that's been the case, right? I mean, it was the first weekend of 4+ days that we averaged 2 million travelers since the holiday season. And looking at bookings, which are a leading indicator ahead, people are going to continue to travel. I mean, the spring break in March could approach or exceed 2019 levels in many of the days overall. And when you look at pricing of flights and other experiences, it sure looks like that's where we collectively are going to spend differently this year.
Mm-hmm. And I think also with a lot of the company policies being a little bit, they have more clarity now going into just how they're going to operate from their own company perspective, which then in turn, the workforce kind of has more clarity with what they can do this year, whether it be Airbnb long weekends where they can work from anywhere. So there's just a lot more transparency now that some of the mandates are either dropped or everything's kind of rolled out that should be baked in.
So again, as you think about the investment standpoint of that, as dollars move in these different areas, it's going to create new kind of supply chain issues potentially, right? Whether it's wedding planning, whether it's flowers, whether it's makeup or other things. Now that masks will be a little bit less than they have been the last few years. So these are just different ways to think, because consumer spending, you look at the retail sales number that came out for January, it's very resilient, right? We continue to spend as consumers. It's just going to continue to be a little bit different. So I think as we have the last couple of years, thinking ahead to where some of those dollars are going, that's where you could continue to see some opportunities. So as you kind of summarize here, as we kind of close things up, it's tough looking at short term as we're going through the ups and downs of the markets right now, with the overseas uncertainty, with the inflation and the Federal Reserve looking to raise interest rates. We talked about this to start the year. Here it is. So what do you do? So we've continued to be cautious near term. You kind of do counterintuitive things. So for example, as you see more uncertainty overseas, oil prices have obviously been up and certain commodities have done well. These are times we look to take profits in certain areas of that for a couple of reasons. Number one, it gives extra cash in the portfolios to look for other opportunities. And number two, a lot of these could be peak, as we talked about earlier. Some of these could be the peak of the cycle on certain aspects of the commodity markets. And it's good to take an advantage because some of those have done really well. But as you kind of look ahead to the rest of the year, some of what we're seeing reminds me a lot of 2003. And back then we were coming off a number of years of the dot-com crisis. And at the time, the Federal Reserve was looking to raise interest rates. There was a lot of uncertainty. Housing market was really just starting to take off. And there were a lot of companies down 70, 80, 90%, which are really, really good times to buy some of those assets. We're seeing similar conditions in this market. I think there could be that type of opportunity if you're patient over the next few weeks and months ahead. So we're kind of mindful of those opportunities. But overall, I think it's prudent to be a little defensive. Look for the opportunities. There's no reason to rush in the near term. Having said that, if you are sitting on cash or have a liquidity event, if the viewpoint that the economy is still going to grow 3.5% or more this year, and we're still going to have that middle single-digit return in the stock market, it's a good time to be buying risk assets right now. And again, we wouldn't necessarily rush to do that, but it's good time to start averaging in or putting money to work. So with that, I want to thank everybody for tuning in this month, and I think Megan will be off for a few months.
I will be missing in action for a few months for maternity leave, but I think we'll have David or other team members step in to fill.
All right, well, Megan, let us know, and we should get the account paperwork ready for baby Kowalski.
Will do.
Thank you for joining, and we'll be live next month.
Thank you, everybody.